We start today's market talk. Everybody enters a casino with the confidence that they have the willpower to fold early should things go south. But everyone who exits the casino learns that almost nobody has this willpower. Stock market is often likened to a casino. Most retail investors fall in the category of false sense of rationality in their investment decisions. 8 out of 10 FNO traders make losses. Promoters are today either doing IPOs or QIPs and making good gains in an overindulgent market. Sharp correction in shares of PSU companies is a sign that investors found the underperformance of these companies and found valuations to be expensive. So the phase of speculative investment based on narrative is over now. Market outlook. Financial markets have turned their attention towards how much the Fed will ease and how fast the economy is slowing. US inflation is close to target, unemployment rate is 4.3%, and economy is growing above the trend rate. US Fed will begin cutting interest rate this month to avoid risk of further weakening in the labor markets. Busy next week with 12 upcoming IPOs which aim to raise more than $1 billion. That is roughly around 8,600 crores. Bajaj Housing Finance, Tollins Tires, Cross Limited, PN Gadgil Jewelers, and 8 SMEs are aiming to raise around 8,600 crore to take advantage of favorable investor sentiment. The recent sell-off in PSU stocks by institutions is driven by two main factors: valuation and performance concerns. Institutions are reducing their stake in PSUs due to high valuations and disappointing earnings. PSU banks, defense stocks are underperforming. Investors need to focus on PSUs with solid growth potential and not rely on broad optimism around PSUs. The rally in mid-cap stocks is primarily driven by investor inflows rather than underlying company fundamentals. Inflows in mid-cap funds contributed to outperformance in the last 1 or 2 years. Strong performance of mid-cap index is due to limited number of stocks driving the gains, resulting in most of the mid-cap funds underperforming the index. Gold is a hedge against risk, a liquid hedge against inflation, and is a diversification tool. Global tensions, higher retail demand, and increased buying by central banks has kept demand soaring for gold. Depreciating rupee has also helped in raising the prices. The next trigger for gold would be Fed rate cut, and the cut in import duty has also helped in raising the domestic demand. Strong rate cut expectations from RBI can push the 10-year bond yields towards 6.5% or even lower. 10-year yield have come to 6.86 already, can go to 6.75. Moment there is a change in stance from RBI, the 10-year yield can go towards 6.5. Now, the weekly data. So if you see Nifty 50 and Bank Nifty both corrected around 1.5%. Gold corrected, silver corrected, and crude oil was down around 8%. And crude oil is now trending towards 70, basically due to lack of demand, which is expected out of China due to lower growth there. OMC stock should do well, but uh, in an environment of lesser supply, then the crude is expected to bounce back. Natural gas prices went up. This is basically because as the winter season is approaching, there is expectations of higher demand in future, so people are trading them, and that is what is cost of carry. Dollar corrected a bit. USD INR also weakened a bit. 10-year bond yields were generally static. NSE market cap came down by around 1%. Market-wide position limits were up 6%. That means people are trading more in FNO market. The Dow Jones, Nasdaq, and S&P 500 all corrected 3 to 5%. which was due to basic weakness in the US markets. Now, talking about US indices plunged due to concerns over economic growth and soft labor market data. US Treasury yields fell due to softer jobs data, lifting bets of a 50 basis point rate cut in September. Now, because of that expectations, the bond yield corrected around 5% last week and has come down to the level of around 3.7. So let's see. And once there's more clarity on this, it can go still further down. It is constantly making lower highs and lower lows. So it is in a constant downtrend. Dollar index has again corrected. It had bounced back, but it has corrected. And now it has come to this zone of around 100 where it has tended to bounce back from. So if it breaks this, then it will go down to 95 level. Brent Crude has corrected and has come down to 72 level. It can fall to this 70 level where generally it has tended to bounce back from. This is basically because of adequate supply and expected to be lower demand in the future. Gold was flat, just came down by 0.24% as more clarity is needed for future direction of interest rate. Copper financial futures were weak, have come down, and there is no super cycle in copper as such. It is correcting, and now it is below the 50 EMA also. So it is expected to go down as demand is expected to be lower. Nasdaq had nearly a 5.89% fall, went below the 20 EMA on weekly charts, and I think it will test at 50 EMA, and then we will see from where it goes. It is below this decline, rising trend line, so it is now looking slightly weaker. The major fall came due to Nvidia, which corrected around 13.86% last week, and on weekly chart it has fallen below the 20 EMA. So this last fall level is the key, should be key support or the 50 EMA, which were around 88 level. So if it reaches this level, it will bounce back. Otherwise, it is expected to go down further. India VIX is a daily chart. So if you see, it was on a rising trend, but it bounced back very quickly to 15 odd levels on Friday due to high volatility and dip in the stock prices. And the indices also had dipped a bit. Indian government bond yields were generally flat and have come at around 6.85. Nifty, let's talk about Nifty. It hit a all-time high on Monday and prices have started to go down from that time onward, from the start of the week. So after the swing low of 5th August, Nifty had, if you see here, after this dip, it had edged higher slowly and was in green for 13 sessions consecutively on a trot. On daily chart, if you see here, it has, after this rise and making a fresh all-time high, it has corrected and broken this 24,500 level. 24,800, once it goes, it will test this first support should be around 24,500, the 50 day moving averages. And if that breaks, then this last support where it took support last time at 24,000 levels should be watched at. So this is where it can go up to, and that should be a decent buying opportunity. It has to break this level for any change in direction. Till right now, it is still making higher highs and higher lows. Once it breaks this 24,000 level, then there will be a trend change, or then you can think of lower levels. It looks difficult due to money flow, constant money flow. So until there is a trigger that reduces fund flows to the market, this trend is not likely to change or there is a reversal expected. There is no money which is stopping into the market. So the first level, as I told you, 24,500 and the next level, 24,000. Coming to hourly chart, made a high, then corrected, and now it has broken the 20 hourly moving average. So it shows it is now weak. Once it is below this, so it should test lower levels. RSI is slightly oversold. So once it goes down, it is expected to bounce back. Nifty Bank weekly chart. So if you see here, same thing with Nifty Bank. It is now below the June highs. So this is definitely looking weak and trying to test uh, the 20 EMA on the weekly chart. So on a daily chart, so if you see here, it has broken the 50 EMA and now may head towards the 100 EMA support or that 50,000, 49,800 level where it took support last time. It is in a bear market. It is making lower highs. So let's see if it makes a lower low from here. It couldn't go up much from here, despite all the positive momentum. Now, Bank Nifty on third, it went up on expiry and then subsequently it has come down and now it has broken all moving averages on hourly chart. So it is now oversold also. So this is ready for a bounce back. Now HDFC Bank was flat basically, is not corrected much. It is at that 1636 odd level. It couldn't go up with the good news and it has not corrected also much. So let's see where it goes. Reliance has corrected. So the news of bonus didn't excite this stock. It is now below the 100 EMA and may test the 2860 odd level. That is a level to be watched at. It is facing resistance in this gap and it tried to cross that but couldn't cross that level. SBI has broken the 100 EMA and with a gap and now it is tending towards the 200-day moving average, which is around 760. So if it breaks this level, then it is expected to go down further. PSU Bank Index, so if you see, it has come to the level at which it was in February. So all the rally of the last 6-7 months is just gone. It made a high on after the election results, and then it has been constantly making lower highs and lower lows. So this is one is looking weak. Midcap index, it is okay. It's not just one bearish engulfing candle, but it is not looking bad as such. So there is no sign, no need to worry till the time it is above the 20 EMA and above this 4th June level. Similarly, with small cap index, it also corrected a bit and it made a fresh high. So we'll have to see here because the money flow comes into these indices. Now, why are the markets correcting? So you see, there are bunch of negative news. First is inventory levels in auto sector are highest. They have 75 days of inventory. Consumption demand seems to be slowing. Secondly, also what is happening is the market is ignoring both good and bad data. So there seem to be a counter cyclicality behavior. That means if the market just is moving on momentum oblique liquidity and not moving or not making any moves on good and bad data. So once it starts moving on good and bad data, then only one can really predict this market. Huge market-wide position limits always results in higher panic as positions are being built by retail. And then lastly, what is we are seeing is high beta in a small time frame. Hence, there is no gradual fall. So these are the points of concern. And that is why on a day only, you will see big corrections, whether you have seen it in June or in the month of July around budget or in August, beginning of August, and now with the impending US rate cuts. Now let's talk about our stocks for the day. Fiem Industry, it's a leading tier 1 manufacturer of automotive lighting and rear view mirrors, catering primarily to the two-wheeler OEM. The company also supplies sheet metal parts and plastic components to the two-wheeler and four-wheeler OEMs. Company's entry into four-wheeler LED lighting segment provides new growth opportunity. Strong presence with key players in the two-wheeler segment. Rising LED lighting adoption in the automotive segment to aid growth. Passenger vehicle segment provides significant growth opportunity over the medium term. Strong financial performance. It added new products like hub motor and motor control unit MCU for electric two-wheeler segment. Now these are their customers. So if you see two-wheeler domestic OEMs, most of the domestic OEMs are there. The bigger client for them are Honda, TVS, Yamaha, Suzuki, and others are also joining in. Two-wheeler electric OEMs, all the guys who are selling two-wheeler electric vehicles are there for as their clients. And two-wheeler global OEMs are also there. They're selling products to them also. So they have a wide field. If you see their quarterly performance, the revenues were up 20%, 21% year on year, and 3.6% Q on Q. EBITDA was also up 27%. Margins were slightly higher, and profit after tax was up 35%. So good, solid quarter, and that reflected in the stock performance also. So if you see EBITDA margin over the last few years has constantly improved along with EBITDA. So EBITDA has now reached around 400 crore level, and EBITDA margins have reached around 14-15% level. Net profit is constantly growing and has reached around 90 odd level, 90 crore, expected to go there in FY27, and growth is decent, around 20%. Profit and loss statement, if you see here, revenue is expected to improve around 15% over the next 3 years. EBITDA is also going to improve around 15 to 18%. EBIT is going to be 17 to 18% higher. Profit after tax will go up by around 18 to 19% over the next 3 years. And expected EPS for FY26 is 89, that is 89 or 90. So at 20 times, it can easily trade at 1800. And in case you start discounting the FY27 early, then it can trade at 2100 level also. EBITDA margins are improving, and they are reaching around 13 to 14 level. ROE, ROCs are improving. Working capital days, etc., are becoming better. Valuations are becoming cheaper. So this stock is not at all looking expensive. This is their product-wise revenue mix. So the highest part is now from LED lighting, around 40%, and automotive halogen, rear view mirrors, plastic molded parts are also smaller parts. Customer-wise revenue mix, biggest customer is Honda. Then TVS Motors, India, Yamaha, Suzuki motorcycle, and replacement market, and now others are coming in. So they have a wide customer field. Coming to their technical charts, this was moving along its 20-50 EMA over the last few months. And now after this Q1 results, it has shot up and has reached around 1600 level. So at every dip, this is a buying opportunity. This is the safest stock to hold right now because of valuation and earning visibility. The next stock I will cover is Canara Bank. It reported lower than expected net interest income growth at 6% year on year, with 17 basis point sequential decline in reported NIMs to 2.9%. Profits were in line as higher other income and low credit costs offset the impact. Sequential loan growth at 2% was led by 12% Q&Q growth in retail credit, mainly led by gold loans. Reported NIM declined by 17 basis point Q&Q to 2.9%, driven by both moderation in yields and rise in cost of funds. So the cost of funds has gone up by 25 basis points and yields have declined by 5 basis points. Hence, the NIMs had to decline. So that means that will affect their profits. Asset quality metrics continue to improve with GNPA at 4.41%, down Q&Q, stable PCR at 71%, contained slippages at 1.4%. So that means asset quality is good, only the profits are declining. Growth guidance at 10% for full year is on a conservative basis. The bank has raised infra bonds as part of borrowing, which came at a lower effective cost than wholesale deposits. So the cost of funds they're trying to reduce. Divestment plans in Canada Revoco to 8 CET1 ratio. CET1 is the common equity tier 1 core capital, uh, which consists of core capital, that is stock and return earnings. And this ratio is with the weighted assets. With reference to the weighted asset, what is the ratio? So this is one of the ratio to see whether there is a capital adequacy in a company. Now coming to their quarterly performance. So if you see here, the net interest income was up around 5.8%, though declined Q on Q. NIMs were lower, so they have declined substantially over Q on Q and year on year, which will affect the earnings. And if you see other aspect, provisions have come down. So that means the asset quality is better. NPA provisions are much, much lower, right? Roughly 579 basis point, both Q on Q and year on year. Hence, profit before tax and profit after tax is higher by around 9 to 10%, which is strong. It is basically because there is less provision and there must be some write backs also taking place. ROA has, because of that, improved. And basic EPS is higher by around 10%. So the basic issue is there is lack of growth, but all growth is below expectation, but asset quality is improving. And there are write backs, so which is coming into profits. So profits are better and ROA is improving. So coming to their balance sheet, so if you see here, their risk-weighted assets are up around 2% Q on Q and 14% year on year. Advances are up around 10% year on year and 1.6% Q on Q. ROA is up to 1.05. Deposits are up 12%. So the basically advances are what they are lending is up 10% and deposits is up 12%. So this is that's how they are expected to grow around 10% over the next 3 years. CASA deposits have declined, but term deposits have increased 3.3%. So that means their cost of deposits or cost of deposits has gone up. So that is why it is affecting their NIMs. Gross advances were up, as I told you, around 1.95%. NPA has declined. Gross NPA ratio and net NPA ratio also all declined now, which is good. ROA, that's why has improved. A loan book analysis, if you see, the main part of the loan book is retail credit. Rest are declining, and retail credit is also primarily gold loans only. So this has to be kept in mind. So margins are constantly now we have seen the best of the margins. Now they will decline from here. Asset quality will improve as they become much more efficient, and credit to deposit ratio is also likely to go up right now. Book value is around 98, 99 for FY25 and 112. So it is trailing at below book value now for FY26 earnings. So it is becoming cheaper. It pays decent 3% dividend, so which is good. Growth ratios are okay. As I told you, advances are expected to go around 10, 11%, and deposits are also growing at around 10, 12% only. So it is at now around book value or below book value for FY26 earning, and dividend yield is around 3%. So it's a relatively safer stock to hold and not much to lose from here. Shareholding pattern. So if you see here, the mutual fund banks, financial institutions have sold over the last 6 months, and retail has added their stock, and that is why this stock has corrected. FIs have slightly increased their positions over the March quarter. If you see the chart, it's on a declining trend line. This is a daily chart, and now it has on Friday it has fallen below the 200 EMA. So this is now really looking weak. Even on the 4th June fall, it had come to only 100 EMA. It tested the 200 EMA for around 109 odd levels. Sorry, 105 levels twice. Bounced back from there, but this but it couldn't cross that 50 and 20 EMA. And now, because of that resistance it was facing, now it has broken this. And RSI is also now becoming oversold. So be careful with this stock. Next stock is this IPO which is coming. Bajaj Housing Finance Limited, second largest, fastest growing, most diversified and profitable housing finance company. The second largest with an AUM of 97,000 crore, having grown its AUM at a CAGR of 71.7% over the last 6 years. Franchise diversity has increased, reflected in significant increase in contribution of LRD, that is lease rental discounting, and developer finance, increase in share of SENP customers. This is self-employed non-professionals within home loan and LAP portfolio, loan against property, and broadening of borrowing mix with increased share of NHB, which is National Housing Bank, refinance, and NCDs. Collection efficiency stood at 99.5% in FY24, and company has well-defined credit evaluation framework and underwriting process to ensure that risk performance across all products remain within the defined threshold. It has most diversified mortgage product suite of home loans, LAP, LRD, and developer finance, forming 57.8, 10.5, 19.3, and 10.5% respectively of their assets, marketed through a network of 215 branches across 20 states and 3 union territories. But notably, they are only in 3-4 states in a major way. Rest, they are developing their business. Within housing loans, company has focused on customers having CIBIL score of 750 plus, 75.8% of home loan AUM, with salaried, self-employed professionals and self-employed non-professionals forming 87.5%, 4.3%, and 8.2% of home loan AUM respectively. Stage 3 assets, which are basically assets or the loans which are overdue for more than 90 days, for all the last few years and Q1 are around 0.2 to 0.3 level, is a testimony of its stringent underwriting standards, comprehensive monitoring, and prudent risk management practices. Significant value could get added over the next 12 to 15 months as 25 to 30% AUM earning growth and 14 to 15% ROE is likely in next couple of years. So last few years, the AUM CAGR is 33%. So even if it is at 25%, it is still having fastest AUM growth. So the book value in FY25 should be around 24 rupees. So you can easily give it a 4 or 5 times book value because of its high growth, asset quality, and Bajaj brand. So it can easily trade at 100 to 120 level. Key strength are growth execution, risk management, and operating efficiencies. Let's see their financial snapshot. AUM has increased over the years and has nearly become 3 times. Reached 997,000 crore. NI, net interest income, total income, pre-provision operating profits, profit after tax, etc. have all improved in a good rate. Book value is expected to improve, as I told you. ROA, ROE are also constantly improving and have now reached decent levels. So 29.3% AUM CAGR over last 4 years. 43.6% disbursement CAGR over the last 4 years. Spreads have improved over long term. That is yield on loans, 10% in this quarter. Cost of funds is 7.9. So spreads are much higher to around 2.2 or 2.3 level. Improving cost ratio is very critical. So their cost to income has gone down, so which is leading to higher profits. And operating expenses to average assets have also come down, so which is decent. So this is the one which is driving profits. ROE has improved substantially over the past 3 years, and ROA has also improved. Strong capital position in terms of risk-weighted assets and Tier 1 capital ratio, and diversified the borrowing mix. So it is well diversified with their borrowing from private banks, public banks, financial institution, NHB, NCDs, CPs, and deposits. Product-wise, AUM, if you see, majority is home loans, followed by LRD, LAP, developer finance, etc. So it's a decent book. So if you see growth and ratio matrix, growth is strong and is trending upwards. So it rose very quickly in initial years. So now it is becoming stable. So the net profit is expected to grow around 37% and continue like that. And assets are also growing. Profitability is good, though NIMs have slightly come down because of higher cost of funds right now. But still, they are better than in the as per that. ROE, ROC, ROA is improving. Uh, uh, EPS is improving, and adjusted book value is also improved. Right now, we are not talking about dividends. Other ratios are good, and stage three assets, that is the loans which are due for more than 90 days, are still pretty low. Credit cost is going down. If you see the compare with the peers, AUM CAGR is the best among Canfin Homes, LIC Housing, which are the prime housing finance company, PNB Housing and Tata Capital Housing Finance. So, but AUM wise, if you see, LIC Housing is the biggest. Total income CAGR is highest among them, 30% as compared to others. Affordable housing, because of their higher spreads, are able to garner higher income and higher income growth as compared to the traditional housing finance company. So if you see here, operating matrix wise, uh, their GNPAs are better than rest of them. Rest of the keeping all the other parameters same, and cost of income is lowest. So OPEX is also pretty low. So their cost of acquisition of customers is not very high, and that's why the ROA, ROEs are good. Valuation wise, they are expensive as compared to other housing finance, but that is also because of their better asset quality, growth, and Bajaj brand. The affordable housing finance guys are comparing are trading at much higher valuation as compared to traditional housing finance. CAGR wise, if you see EPS, all the affordable guys have moved at around 20% EPS CAGR, and book value has grown up around 15 to 18%. So they are reasonably decently performing as compared to all of them. I have finished. We'll take questions now.